all seen commercials or ads for credit cards, but what is credit and what role does it play in our personal finances? Simply put, credit is a contractual agreement where the borrower receives something now and agrees to pay the lender back later, usually with interest. This is not to be confused with the credit transactions, like a deposit or tax refund, which you may see in your bank statements. Let's look at an example. Your air conditioner breaks down in the middle of summer. You need it to get replaced as soon as possible, but you don't have enough money saved up in an emergency fund to pay for a replacement. You decide to use a credit card to buy the air conditioner now, borrowing the money from the credit card company. The credit card company will charge you money each month. This is called interest, and it's based on the amount you borrowed, which is called the principal, if you don't repay that full balance by the statement due date. In this example, you're the borrower, and the credit card company is the lender. As you can see, anytime you borrow money, you are using credit. Other common credit products are mortgages, lines of credit, and loans. Credit products can be grouped into two categories: installment or revolving. Mortgages and loans are considered installment credit products because you borrow a lump sum of money and then make fixed periodic payments. Each payment will go towards your interest and principal. In the early part of your loan, a high percentage of what you pay is applied to the interest. This amount is reduced as you pay your installments, and you'll do this until the full principal amount you borrowed and the interest are paid back to the lender. This is why taking loans with shorter timelines to repay the balance can be beneficial, as the total interest charged will be lower. Installments are usually designed for longer terms, and these predetermined installment payments are generally structured to your budget and financial comfort level. Lines of credit and credit cards are considered revolving credit products, as you can borrow as little or as much as you want up to your pre-approved limit. The amount you're required to pay the lender each month depends on how much you are borrowing. This type of credit is usually used for shorter terms, and if you don't use it, no interest is charged. Here are a few terms that you should know when it comes to revolving credit. Minimum payment is the minimum balance that you are required to pay by your statement due date. But a word of warning, if you don't make the minimum payment amount, or if you don't pay it by the due date, your credit score starts to go down. The interest rate that applies to your purchases may also be increased. And if you miss too many payments, you could ultimately lose your credit. Nobody wants that, so use your credit responsibly. And if you make a habit of only paying the minimum payment on the due date, it could take you years to get out of debt. This can be made even worse by something called compounding. So, some credit cards and lines of credit not only charge interest on your principal balance, but also on any unpaid interest charges from prior months. For example, say you bought $5,000 worth of goods on your credit card with an annual interest rate of 18%. Your credit card statement says you incurred $75 worth of interest during the period. Any unpaid portion of this $75 would be charged interest again on your next statement, which is why it's called compound interest. Think of compound interest like rolling a snowball on the ground. The interest is the snow on the ground, and the snowball is your principal. The larger the snowball gets, the more snow it picks up on each roll. Eventually, the snowball becomes so big that you can't move it anymore. All that to say, if you allow compound interest to occur on your debt, it can make it even more difficult to pay off your balances. Now that we know about different credit products, let's talk about how lenders determine how much we can borrow. When we apply for credit from a lender, a report is created that shows all our current and historical activity with other credit products, among other things. This report shows the lender how we manage credit, our ability to repay loans, and how risky it would be for them to lend us money. The information in the report is summarized in the form of a number. This is your credit score. Usually, the higher your credit score, the better. With your permission, a credit report can also be used by different businesses or individuals to help them make decisions about you, like how they'll go about collecting an outstanding debt, whether they should rent you a property or offer you a job or promotion, provide you with insurance, or offer to increase your credit limit. While a credit score is essential for being approved for credit, it doesn't indicate how much you're qualified to obtain. This means when determining how much credit to give you, a lender will want to ensure that your debt payments are manageable and that you don't take on too much debt. Lenders will review your monthly income and expenses to help make this decision. Any minimum payments or installments you are required to make on borrowed money are included in these expenses. As you can see, it's really important to build and maintain a good credit history and score while also ensuring that your debt payments are manageable. This can be one of the key factors that lenders consider when you're applying for any type of credit. This is especially true for younger people who may eventually want to buy a car or a home. Unless they can pay for it in full, they'll most likely need to get a mortgage or loan. And one of the easiest ways to gradually build up a credit score is to always pay your bills on time. Finally, as we just learned, not all credit products are the same. So take the time to determine which one meets your needs best. Before applying for credit, it's a good idea to research the product thoroughly and ask the advice of a professional, if necessary. Although credit products can seem overwhelming, they can be an important tool to help you achieve your financial and life goals.